PhillipCapital Weekly Market Watch. I'm Camelia, Business Development Dealer from Phillip Futures. For this week's episode of Market Watch, I'll be focusing on crude oil prices. Crude prices have been very volatile lately, and the WTI has been trending within the range of $43 to $49 per barrel recently. However, we are not seeing a clear indication of a strong rally and recovery despite the fall in the US crude inventories. We have identified three key reasons as to why crude prices is not recovering. A weaker global economic outlook is elevating concerns that demand for oil will collapse, leaving the crude oil market overstocked, despite some positive indication that oil production is finally starting to slow down. Based on the chart, the leading China manufacturing PMI has fallen to 47 in September 2015, a 6.5-year low, pointing to a decline in factory activities for a 7th straight month. Together with the recent Fed's bearish message on China's economic difficulties, the world's second largest oil consumer, it has shaken the oil markets negatively. Secondly, the existing oversupply is immense. Having built up over the course of a market share war between the OPEC cartels and a booming US shale industry over the past years, it will take some time for the stock to clear. Although the Energy Information Administration has reported week-on-week fall in the US production rates are still at a record high of 9.3 million barrels per day as per the 15 years historical chart, and production is still outdoing demand. Thirdly, the likelihood of Iranian sanctions, scheduled to be lifted in November 2015, put the recent price hike to a halt as prices tumbled and reached a new low of about $38 per barrel in August 2015. The severity of Iranian sanctions being lifted are not to be taken lightly, as the lifting of Iranian sanctions will allow Iranian crude, which was previously restricted, to flow back into the market. From the chart, in 2010, OPEC reported Iran's average production to be at 3.7 million barrels per day. Compared to August 2015, we are only seeing a production of 2.9 million barrels per day, suggesting that there could be a 0.8 million barrels per day surplus, and this amount to about 1% increase in the global crude production. Since the main cause of the oil price rout comes about from oversupply, more supply to the market is going to be damaging to oil prices. Therefore, we believe that crude prices will likely stay range-bound at about $40 to $50 per barrel until November 2015, where the Iranian oil might return to the market and push the price down further. However, if we continue to see a steady drop in the US crude production figures, or if OPEC decide to intervene and cut production figures, these scenarios could likely cushion the impact from Iranian crude oil and support prices for chances of recovery. With this, we have come to the end of this week's edition of Market Watch. For more information on the risk and return of investing in the crude oil markets, you may approach any representative from Phillip Futures. Please subscribe to us on PhillipCapital YouTube channel and Facebook, and stay tuned for more Market Watch videos. Thank you.